Conclusion. Let us conclude our entire discussion on the second module of the partnership accounts. We discussed admission, retirement and death and the adjustments required, accounting entries that follow in all these three situations. What happens here is actually what is called a reconstitution of the firm, because there is a change in the profit sharing ratio. On admission, the profit sharing ratio changes, on retirement it changes, and on death it changes. So what happens in case of admission? When a new partner is admitted, bringing in new capital, new expertise, new skills, whatever he is admitted into the partnership, the old partners, they stand to lose in the future benefits of the firm. What do we do therefore? We need to find out what is the loss that the old partners will suffer. What is this? This is called the sacrificing ratio. The old ratio was so much, new ratio is so much, old ratio minus new ratio. If the old ratio was higher, then they are making a sacrifice since their new ratio is now lower. So what is the sacrificing ratio and why do we need the sacrificing ratio? Because it will be in this ratio that share of goodwill will be credited to the old partners. How do we find out share of goodwill? If there is no goodwill in the balance sheet, but inherently the firm believes that there is an amount of goodwill, the amount of goodwill is valued, computed, and the new partner's share in this goodwill is debited to his account and credited to the old partners in their sacrificing ratio. Similarly, all assets and liabilities may be revalued. It is possible that the assets and liabilities which are shown in the balance sheet are not at their real values. Actual values may be different, may be higher or may be lower. All such increase in values of assets, all such profits on revaluation should belong to the old partners and not to the new partner. Therefore, a revaluation, it is always suggested that on admission, a revaluation of assets and liabilities is done and any profit or loss be transferred to the old partners in their old profit sharing ratio. We also discussed that such revaluation of assets and liabilities may be done under three methods. One is preparing the revaluation account. One is so that the new value of the assets and liabilities is reflected in the balance sheet. Two was preparing a memorandum revaluation account as a result of which the new values are not reflected in the balance sheet. Or three, we prepare no revaluation account. We only compute what is the profit or loss on revaluation. If it is a profit, we debit the new partner's capital account with his share in this profit and credit the old partners in their sacrificing ratio. If it's a loss on revaluation, we do just the reverse. Similarly, if there are accumulated profits and losses, general reserve account, if it exists in the balance sheet, it should be transferred to the old partners' capital accounts in their old profit sharing ratio. If there are accumulated losses, the new partner should not suffer for these losses and such losses should be written off to the old partners in the old profit sharing ratio. These were largely the admissions largely the entries that we passed on admission of a partner. In case of retirement, a partner leaves. In case of death or retirement, what happens is we compute the gaining ratio, not the sacrificing ratio, because the remaining partners usually stand to gain when a partner leaves. Here also we compute the share of goodwill. What does the retiring partner get? The retiring partner is entitled to his share of goodwill, to his share of the revaluation profit or if it is loss, he must bear his share of the loss. Accumulated profits and losses, general reserve or accumulated losses must be borne by his share must be transferred to his capital account. Whose capital account? Retiring partner's capital account. Similarly, then the new entry we did was with respect to joint life policy. What is a joint life policy? A joint life policy is a policy which is taken out on the lives of all the partners of the firm. Why is this done? This is done so that in case of a retirement of a partner or in the case of death of a partner, the amount which is received from the from the insurance company can be used to settle the account of the retiring partner or settle the accounts of the deceased partner and pay the money to the deceased partner's executors. Here also we discussed that there were 3 methods of treating the joint life policy premium. Premium which is paid may be treated as an expense, or the joint life policy may be taken as an asset, or the joint life policy may be taken as an asset with a corresponding reserve of the same value. What is the value? Joint life policy, when it is treated as an asset, can be shown only at its surrender value. In case of retirement, if there is a joint life policy, since there is no death has occurred, the amount which is received on the retirement of a partner is the surrender value and not the maturity amount, not the policy amount. And therefore, finally, the retiring partner has to be paid all his dues, which actually consists of the capital amount, the balance in the capital account, the share of goodwill, the share of revaluation profits or losses, the share of accumulated profits and losses, the share of the surrender value of the joint life policy or the surrender value of all the individual policies. That summation of all this has to be paid to the retiring partner. Either payment is made immediately or it is transferred to a loan account and paid as and when the partnership has sufficient funds. If it's kept as a loan account, usually interest is also payable, as would be the case in case of any loan. Next is death. Very similar to the retirement, we have the gaining ratio. Share of goodwill. Share of goodwill will be credited to the deceased partner's account and debited to the remaining partners in their gaining ratio. Deceased partner's capital account will be credited with the revaluation profit or debited with the revaluation loss. Any accumulated profit, share of that will go to the deceased partner's account. Similarly, if there is a loss, it will go to the debit of the deceased partner. The extra thing that we do in case of death is the profit in the current year up to the date of death. Death is sudden, it can happen any time during the year. Retirement is often planned along with the end of a financial year. But in case of death, when it happens suddenly in the middle of the year, an extra computation needs to be done for the amount of profit from the beginning of the year till the date of death, that year's profits. This is usually an estimate and based on the previous year's profit. So if previous year's profit was 1,20,000 and death occurs after 3 months, then it is assumed that the profit for this 3 months would be 30,000. The deceased partner's share in this 30,000 should also be credited to his account. Next, also joint life policy. In case there is a joint life policy, on death of the partner, the maturity amount will be received. Maturity amount will be received. Policy amount will be received, and this is credited to all the partners in their profit sharing ratio, old ratio. Finally, the entire amount which is payable to the deceased partner would be the executors of the deceased partner would be the capital account, share of goodwill, pre-valuation profit, share of accumulated profits, share in the profit in the current year, estimated profit of the current year, share in the joint life policy amount. This entire amount would be transferred to the executor's account of the deceased partner, either paid off immediately or retained as an executor's account till funds are arranged to pay the amount. With this, we conclude our discussion on partnership. Thank you.